Buenas tardes. Hace 12 meses, en septiembre de 2020, hablamos con Jurrien Timmer, director global de macro de Fidelity Investments en Estados Unidos, para conocer su visión sobre los mercados de deuda y de acciones. En aquel momento, la situación económica global era de una profunda recesión, la mayor de los últimos 80 años. Las vacunas todavía no habían hecho su aparición, aunque había 250 proyectos trabajando en ello. Trump era todavía presidente de Estados Unidos y aquí en España estábamos en plena segunda ola. La situación ha cambiado mucho en este último año y por eso pensamos que era una buena oportunidad para volver a escuchar a Jurrien, cuya opinión es una referencia obligada para analistas, gestores de fondos y todo el equipo de inversiones de Fidelity, y que nos acompaña desde Boston, en Estados Unidos. Good morning, Jurrien. Thanks for joining us.
Nice to see you. It's been a while, but it's good to see you. It's good to be back.
It's good to be able to talk to you again. Before we start, please correct me if I'm wrong. I think that the Burning Man event in the Nevada desert was canceled for the second year in a row. Is that correct?
It was, and when it was canceled, this was maybe 6 months ago. It was a very controversial decision because at that point, the third COVID wave in the U.S. was really coming down. But in retrospect, it was the right decision because now we have the Delta wave. But there were about 15,000 people who went to the desert, but it was not an officially organized event. So I did not go for the second year in a row, unfortunately.
Well, we know how much you enjoy the event. We're showing a picture as we speak of your presence there, enjoying a glass of wine. I think this is back in 2019.
Yeah.
And hopefully next time we talk, we can show a more recent photograph of yourself at the event.
Yes, I hope so.
But let's pick up where we left off last year. I remember you mentioned back in September of 2020 that you were optimistic about markets, provided that vaccines made their appearance and that restrictions were lifted. That did happen, and indeed markets performed very well. Are you optimistic now as well? What's your outlook for the short term?
Yes, certainly a lot has happened since we last spoke, and that was that whole market cycle with the 35% decline in the S&P 500 going right into the lockdowns, and then really an incredible recovery. The S&P has risen 103% from that bottom in March of 2020. So it was an interesting time to be a market practitioner. As you know, I'm a student of history, and studying history served us very well last year, because based on the history of the markets and how they behave, we were able to conclude back in March, even though the world seemed to be falling down around us, that the market had reached a level that almost always would lead to some kind of recovery, and and it did. And so here we are a year later since we last spoke. I'm still optimistic. I think we are in a sustainable mid-cycle bull market. That's not to say that we don't have a challenge right now. If you look at the technicals pretty closely, the S&P 500 is testing its 50-day moving average. We have a few things to worry about. One is that it's September, and that is typically the seasonal time frame where corrections may happen. We have, of course, the Fed, which is about to start tapering, and we'll talk about that, of course. We have the Delta variant, although I think there's some good news there that, at least in the US, it seems to be rolling over a bit. And then we have China, which is really taking very, very severe measures to kind of create more top-down control over the economy. And we have, the property sector in China with Evergrande probably going to be missing some bond payments. So we have a number of things to worry about, but then again, there are always a number of things to worry about, and yet the market usually ends up, kind of overcoming that. So yes, I remain constructive, but we are in that window where we might even see a 10% correction in the coming weeks. And for me, as a long-term investor, I'm not too worried about that.
You touch on a number of interesting things there. Let's dive into some of them. And let's start with COVID. What is your assessment of the pandemic situation in the US? And how dependent do you think that economic growth is on the evolution of the Delta variant?
Yeah, so it's been a very interesting thing to watch. Frankly, I guess I'm just naive, but 3, 4, 5, 6 months ago, when the third wave was cresting in the US over the winter months, and it was really coming down, I thought, okay, we're finally done with this pandemic. And then the Delta variant, started in India, then it went to the UK. But in the UK, there were a lot of new cases, but it didn't lead to a lot of hospitalizations. And so even then I was thinking, okay, if it gets to the US, there'll be new cases, but there'll be young, healthy people and not people that would go to the hospital or God forbid, even die. That has not turned out to be correct, because we've had a very big wave, and it actually has led to a lot of hospitalizations and some deaths in the US. And I think the reason the US is different from the UK is that in the UK, vaccinations have been much more uniform. The overall vaccination rate has been higher. I think it's 71%. In the US, it's in the 60s maybe. But the US, as you probably know, there are certain states that are more vaccinated than other states. We tend to think of them as the blue states versus the red states. So in states like Florida and others where vaccination rates were lower, the Delta variant has been a really big problem. But the good news is that wave seems to be rolling over. So the way I look at these COVID waves is not so much by reported cases, but by what percentage of hospital beds are occupied by COVID patients. And we can get that data. It's readily available on, for instance, our Bloomberg terminals. And so in the peak of the third wave in the winter, it was about 19%. So 19% of hospital beds were occupied by COVID patients. Then that fell all the way down to 2% in the spring and summer. Now it's up to about 13, 14%, which is, again, it's much worse than I had expected, but it seems to be stabilizing. And kind of the silver lining here is that unlike the last waves of COVID in the US and elsewhere, which led to severe lockdowns in the economy, this latest wave has not really changed anything in terms of economic activity, other than maybe mandating mask wearing or some social distancing. But when you look at some indicators of how locked down economies around the world are, the US really did not lock down at all, despite this very large Delta wave. And now that the Delta wave is cresting, that suggests that we won't get any further lockdowns. And that means that the economy can just kind of keep doing what it's doing. The flip side of that is that we're not going to get that economic boost as the Delta wave comes down, because we didn't have the lockdown to begin with. So last year we had a much more significant economic recovery because the whole economy was locked down. We won't see that now, but it looks like the Delta wave is peaking and will be improving in the coming months, and that the economy will continue to be able to expand as it has been for the last year or so.
You mentioned the impact of COVID on economic activity. This seems to be a very strange cycle. I mean, just 18 months ago, we were in the midst of a very deep recession, and now it seems like we are experiencing typical late cycle symptoms. Very unusual, isn't it?
It is very unusual, and there's I think two reasons for it. One is that the pandemic, of course, was not a typical economic cycle, right? So like the financial crisis in 2008, that was not a typical cycle either. But typically, there's a lot of damage that's done in the economy because businesses had leveraged too much, and then the central bank tightens policy. You have an inventory overhang, and all of that takes time to resolve. And in the financial crisis, of course, we had a balance sheet recession where there was too much leverage. So that really was all about leverage, and that took years to recover from. The pandemic, COVID, it's more like a natural disaster, but on a global scale, right? So if a country gets hit by a hurricane or an earthquake, everything stops, but it opens up relatively quickly. And I think kind of the US and global cycle around the pandemic can be kind of thought of in that way. But there's another element as well, and that is that the Fed and other central banks responded very, very quickly and with a lot of force, right? And it's not just the monetary side, but the fiscal side as well, around the world, but especially in the US with the CARES Act, the fiscal stimulus. I mean, the government added about $5+ trillion of deficit spending to bridge the gap, to build that bridge over to the recovery side. And the central bank, the Fed, played a very large role in that. It did asset purchases by about $4 trillion. It obviously immediately lowered rates to zero. And those asset purchases are continuing, although the Fed will taper soon, and we can talk in more detail about that. But in the process of having this very, very fast and extremely powerful response, both by the fiscal and the monetary authorities, I liken it to, you have a market cycle, and you have the middle, which is growth. Then you have the right tail, which is the overheating, which is typically late cycle, right? Inflation pressures, labor shortages, monetary tightening. And then you have the left tail, which is the economic downturn. So my sense of it is that the roadmap was more of a natural disaster, which is a quicker recovery, a very sudden breakdown, but a quick recovery. And two, through this policy response, the left tail was kind of removed from this cycle. I mean, maybe not removed because the market still went down a lot, but it was at least truncated, right? If you look at home prices in the US, they didn't fall during COVID because homeowners were essentially protected. People paying rent were protected. You could not evict a tenant for not paying rent, for instance. And now home prices are up 20%. And the real estate market, I don't know how it is in Spain, but here in the US, it's crazy right now. And because prices are recovering the way they would normally do, but they never went down first. And so now they are recovering from a higher level, and they reach extremes quicker, and they reach supply shortages quicker, because you never had that washing out at the bottom where people go bankrupt and they get foreclosed on. And so the Fed, I liken it to, it kind of removed or truncated the left tail of the cycle, and that brings us quicker to the right tail. So even though we were in a recession a year and a half ago, and we then went to early cycle recovery and are now in mid-cycle, already 17, 18 months after the recession, we are already seeing late cycle pressures through inflation, labor shortages, and very soon the Fed removing accommodation. So a very interesting, very unique cycle from those two perspectives.
So let's touch on valuations and profits for a second. Are you comfortable with the current levels of valuations. Do you think that earnings will continue to grow, thus bringing down the price earnings multiples?
Yes, I have not been overly concerned with the valuation side of the stock market. I mean, valuations are high, there's no question about it. And especially people who are more bearishly inclined will look at what's called the Shiller-Cape ratio. So the cyclically adjusted PE, it's a very well-known ratio. It's the price to the average of the last 10 years earnings. And on that metric, the market is almost as expensive as it has been at the major extremes. 2000 was obviously one, 1929. So when you think about it in those terms, you're like, oh my God, the market is a bubble. But I don't think that's the right way to look at it, because that approach does not take into consideration the level of interest rates or the percentage of earnings that are paid back or distributed back to shareholders, either via dividends or share buybacks. So the payout ratio is an important function that we need to think about, as well as the level of discount rate, the level of interest rates, because when you think about it, the way I look at valuation is through the discounted cash flow model, right? So earnings growth in the top, the discount rate at which we discount those earnings in the bottom. And so a PE ratio doesn't really take any of that into account. So how I look at it is I look at price to total cash. So obviously earnings growth matters, and you asked about earnings growth, and earnings growth has been incredibly strong. What you can see from the pandemic is that companies have so much operating leverage now that the profit margin has gone through the roof. And so that's been a very strong, powerful earnings driver. And so we have very strong earnings, probably on a rate of change basis. They are peaking now, but earnings are strong. And share buybacks are very strong right now, especially from the large cap growth companies who produce a lot of free cash flow. And so the payout ratio is high. The discount rate, the 10-year treasury yields 1.3%, very low. So when you take all of that into account, the market is much more reasonably priced than if you just look at a traditional PE ratio. And the other element to this is that the way market cycles work, and I'm sure we talked about this a year ago, is that typically, investors always look forward, right? They discount the future. They don't always discount it correctly, right? So the market's still made up of people, of course, who make judgments in real time. But typically how market cycles work at the bottom is that price will bottom first, and then earnings will bottom a couple of quarters later, just because the markets are discounting. They can see the recovery, but it's not there yet. And during that period of, let's say, 3 to 6 to 9 months, price will go up, but earnings are still falling because earnings are a lagging indicator to price. And during that window, by definition, mathematically speaking, the PE ratio will go up. And what happens during a typical cycle is exactly that. And during the period before earnings start to bottom and start to carry the load for price, right? Starting to support the price action, during that window, the PE ratio typically goes up about 50% from whatever the low was. And that's exactly what has happened this time around. So the market, even though it's been completely a strange cycle, and a year ago, I'm sure we were talking about how there was this perception of the markets being totally disconnected from reality because the world was still, burning, but price was already soaring. And in retrospect, and actually in real time, we thought that as well, because again, we study history and we know that that's how cycles work. But the markets made a lot more sense than a lot of people thought they were, because you have that timing difference between price and earnings. So the long story short is that earnings are now carrying the load for price. That has allowed the PE to come down. It's still at high levels from an absolute point of view, but it's coming down as it typically does. So I think the markets are actually functioning fairly normally from that perspective, with the caveat that this policy response that we just talked about in the last section accelerated everything, right? So everything did recover faster, stronger because of that removal of the left tail. And that's why we are now closer to late cycle environment than we otherwise would be.
So I take it you don't believe that the large mega caps are overvalued. And I recently read a piece from you on the Nifty 50.
So I've studied this for a long time. I first started covering this back in the 1990s, actually, over 20 years ago, because the original Nifty 50, right? So the Nifty 50 comes from the 1970s, which was a period in the early 70s where we had a speculative bubble in the late 60s, a lot of retail speculation, kind of like what we see now and what we saw in the late 90s. And then we had a recession, it wiped out that speculation. And then in the next recovery, most of the money that was invested in the markets was in the hands of large institutions or institutional investors. And they only wanted to buy proven growth stocks, right? And back then that was, companies like IBM, Xerox, Procter & Gamble, Colgate, what have you. But companies that were proven to be solid quality growers, because everyone had gotten kind of wiped out from the speculative fever from the previous cycle. And so that group of stocks were called the Nifty 50, and they traded at a tremendous premium to the rest of the market. At the valuation peak back in 72, 73, 74, those stocks were trading at twice the PE of the rest of the market. Okay, that's a very big gap. So then that went away. Inflation kind of, took the valuation out of all of the stocks from the 70s. And then we had a second Nifty 50 in the late 90s, of course, the dot-com boom. And we all know about that story. And again, the relative valuation premium of those top 50 largest stocks to the rest of the market was again about 2x. It was about 100%. So those stocks were 100% higher priced than the rest of the market. So now, of course, we are in what I call the new Nifty 50. So since about 2014, again, these largest growth stocks, we call them the FANGs, but you know who they are: Apple, Google, Amazon, the big growers, the big companies that have achieved tremendous network advantages because their network is so powerful, and they're generating a lot of free cash flow growth. And more importantly for investors, the excess of the free cash flow that they generate, that they don't need to make acquisitions or pay dividends or do capital spending, the excess of that is being returned to shareholders via share buybacks. And that's a very important phenomenon that is relatively unique to the US, more so than Europe or Japan. And so that has been the dominant group. It's outperformed over the past 7 years by about 3,700%. I mean, a very large move. And even though it has vastly outperformed the rest of the market, the important takeaway is that its valuation premium is far less large than its performance premium. So these 50 stocks trade at a PE multiple that is only 4 percentage points higher than the rest of the market, whereas in 2000 it was 20 percentage points higher. So in other words, these stocks have done extremely well. They are continuing to benefit from these kind of impenetrable networks that are hard to compete against. They generate the cash flow, they generate the earnings, of course, but all of their performance relative to the rest of the market has been justified by these earnings fundamentals. So I, for one, think that the new Nifty 50 can continue to outperform for as long as that persists. And again, a company like Apple, I don't cover individual stocks, but a company like Apple trades at 30 times earnings. That's higher than the market, but it's not 100 times earnings. It's not at crazy levels. So I think the Nifty 50 phenomenon is sustainable for that reason.
You mentioned earlier in this conversation the important role of central banks in this cycle. We heard from the Fed in late June, and then again we heard from Jerome Powell in late August from Jackson Hole. From what he said, can you infer what will happen and when?
Yes, I think the Fed correctly concludes that the crisis has passed and that we have very quickly reached some late cycle pressures. Now, the Fed is dismissing the inflation that we're seeing. The CPI is running at 5.3% year over year, so that's a very high level, but it's very likely going to be transitory to some degree, right? Because the CPI inflation measures are measured on a rate of change basis. And of course, a year ago, we had very significant supply chain bottlenecks, and that has led to higher prices. So that will run through and the CPI will come down. But the question is, how much will it come down to? Will it go back to 1% or 2%, or will it settle in at 3 or 4%? And so the Fed is saying it's transitory, we're not worried about it. And the Fed may or may not be correct, but the market seems to agree with that assessment, because if you look at the TIPS market, the Treasury inflation protected securities, so that's a part of the bond market that are inflation linkers, they're pricing in 2.2% inflation over the next 5 years. So the market seems to be in agreement with the Fed, and we will see, how correct or incorrect that is. I do think that there will be some stickiness to the inflation, mostly through wages and through housing, through rent or home prices. And what you see in the labor market is really very interesting, because there are 8 million unemployed people in the US, but they don't seem to be in a hurry to find a job, because there are 11 million open jobs in the US, and that gap has been there now for a number of months. So there is a labor shortage, even though there are a lot of people who are technically unemployed. And so that should create some wage inflation. But on the surface, it creates at least the illusion that there are a lot of unemployed people, and until those people are back in jobs, the Fed needs to take it easy, right? And so I think if there's going to be a policy error on the Fed's behalf, by remaining too accommodative for too long, my guess is that it's going to be for that reason, that they look at all those people unemployed and say, we need to bring those back in, which of course is a very noble goal. The Fed has two mandates: full employment and price stability. But this is a very strange cycle, as we know, and there's a lot of job openings. People are also quitting jobs at a very, very high rate. But anyway, back to your question, the Fed does know, correctly so, that 0% interest rates and $120 billion of asset purchases per month are probably no longer needed at an economy that has recovered as quickly as it has. And so now the question is, how does it normalize? What is the sequence? Because it's doing two things: it's buying assets, and it has rates at all-time lows. And so if it's going to normalize policy, the thinking is that it first needs to reduce asset purchases until it is completely done with asset purchases, and then it can start raising rates. Typically, that is considered the right sequence. And if we look at the Fed's dot plot, it suggests that the Fed will start raising rates in 2023, which is about a year and a half from now. And that would suggest that the Fed first needs to go from 120 billion of asset purchases all the way to zero before we get to 2023. Well, it's already September 2021. The Fed hasn't even announced when it will start tapering and how it will taper. So it needs to do that first. And the thinking was it was going to be at Jackson Hole at the big Fed conference. That didn't happen because we had several misses on the employment report. Then it was September. That did not happen. So now we're thinking October, November, it will be announced. Maybe December, it will be implemented. But then they only have about a year to go from 120 to zero. So it's probably going to be an accelerated taper of maybe 10 or 20 billion a month reduction of purchases. But that's where the Fed is, and it's it's where the Fed should be, right? I mean, the emergency has passed, at least economically speaking, maybe not medically speaking, and the Fed needs to start start being less accommodative. So now comes the hard part where they actually have to implement this. And I think the markets will be okay because the markets are expecting it. And as long as the markets expect it, I think there will be really minimal impact for the time being.
So on the topic of the likely path for interest rates, you've touched in the past on the analogy with the 1940s. Is that a likely scenario for us for the next few years?
I think it is, right? So people look at the inflation issues right now and they immediately think to the 1970s, long period of stagflation, markets didn't go anywhere. I don't think that's the right parallel. I don't think whatever inflation we get is going to be that severe. We have very powerful deflationary trends underway. You know, technological innovation is very deflationary. Demographics is deflationary. The high debt levels is deflationary. So I don't see, 5-10% inflation, but I could see 3 or 4% inflation. And then it's a question of what does the Fed do about that? And my sense is that the Fed will not do very much about it, that the Fed will just accept it. And so the 1940s is an interesting analog to today because obviously that was the World War II decade. And the US, the Federal Reserve was not yet independent back then. So when the US entered World War II in 1942, it tasked the Fed with repressing interest rates at very low levels and to monetize the increase in debt by buying assets and putting it on its balance sheet. So that was really one of the first iterations of quantitative easing back then. And so that lasted for almost a decade. And the long bond, the 10-year yield was capped at 2.5%, even though inflation at times ran at 5-6%. And so that, I think, is maybe a roadmap for what might happen if interest rates decide to start climbing because they are following inflation rather than Fed policy. We don't know if that's going to happen yet, but we can tell just from looking at the relationship between nominal yields and the TIPS market that the 10-year yield is about 100 basis points lower than it should be. And so yields already should be around 2.25%, and instead they're at 1.3. And so the Fed, of course, plays a large role in that because it's buying $120 billion worth of bonds every month. So I do think the Fed, even though it is talking about tapering, or it's going to be talking about tapering, ultimately the Fed is going to be more like the Bank of Japan in the future, where it will just continue to be involved in the bond market. I mean, the ECB is no different, of course, and that ultimately maybe the US bond market will look more like the Japanese bond market, where it becomes less of a market and just more of a way to fund deficits. And it's interesting, I did a little study on this. The Bank of Japan owns half the all of the debt in the U.S., all of the government debt in Japan. Sorry, not in the U.S. that would be something. So the Bank of Japan owns half of the Japanese government debt, and it's buying about half of the new issuance every month. The Fed owns about 26% of the U.S. federal debt, and is buying about a third of the supply every month. And so in another 5 years or so, the Fed could be closer to where the Bank of Japan is. And that's important because in Japan, interest rates are zero. The volatility of long JGBs is about 3. In the US, the annualized volatility of US long bonds is about 11. So the Fed may end up taming the bond market into submission in the coming years, regardless of what we are talking about with the Fed tapering or not tapering. And so in that sense, that's what the Fed did back in the 40s. The Barclays long-term government bond index during the 40s had an annualized return of 2.3% and an annualized volatility of 2.3%, even though inflation was running at 5 to 6%. And I wouldn't be surprised if we do some sort of repeat of that.
And to conclude, you stated over a year and a half ago that we were in a secular bull market. Have your views changed in any way, or what are the drivers of this secular bull market?
Yeah, no, I believe we are in a secular bull market, and if I had only 1 minute to tell why, it would be very simply three things: demographics. So investors are getting older. They want income, right? Older, the aging baby boomers want income. Generally, as people get older, they don't solve for growth; they solve for cash flow and income. So one is that. Two is we're in a world of ultra low interest rates, even negative nominal rates, but certainly negative real rates, at least in the US. So that's two. So people want income, they can't get it in the bond market. And then in the stock market, we have these nifty 50s who provide a lot of cash flow, and the cash flow that they don't need in their business, they return to shareholders via dividends, but dividends are fairly low in the US, but mostly through share buybacks. And those three things together, to me, explain everything that we're seeing in the markets. And my sense is that we've been in a secular bull market since 2009. And again, the way I define the secular bull market is simply by looking at history. Again, student of history, you have periods when you go back a couple of 100 years in the market follows this central trend line of about 10% per year, nominal 6% real. But within that 150-year period, you have very distinctive periods lasting several decades where the return profile is much stronger. It's about 18% per year. You still have corrections, bear markets, recessions, but they tend to be short and swift, and they tend to be over quickly, and the market tends to recover to new highs very quickly. Whereas secular bear markets are the opposite. They're prolonged periods, usually lasting about 14, 15 years of below average returns. And in those periods, the cyclical downturns are much longer and deeper. But since 2009, it's my thesis, and it cannot be proven until the history books are written many years from now. But it's my thesis that we are in a secular bull market similar to what we saw in the 80s and 90s and what we saw in the 50s and 60s. And I've officially been of the belief that we're in a secular bull market since early 2013, which is when the S&P for the first time, made a new all-time high above the extreme set in 2000 and 2007. And so since May of 2013, I've put the burden of proof on that thesis on the markets by saying, what are the markets doing? And are they confirming or denying the thesis that we're in a secular bull market? Because secular bull markets behave in a very specific way, as I just outlined. And so far, everything that has happened confirms the thesis that it's a secular bull market. So even the COVID, the 35% decline in the markets during the lockdown, that obviously is a very large decline, but it recovered very, very quickly. And now we're up 100%. That's very much in line with secular bull markets. And so if I assume that we're in a secular bull market, which I do, then what that means is that corrections, even if they're very harsh, like the one last year, are going to be short-lived, and we're going to be at new highs relatively quickly. And that by that analog, we probably have another 5 to 7 years left in this cycle, super cycle, I should say. If we just extrapolate the past, which can be a dangerous thing, especially if the sample size is small as it is here, but if we extrapolate those past two secular bull markets onto this one, the S&P 500 could be at 8,000 in the next 5 years. And so that doesn't mean we shouldn't be conservative at times of risk, like last year, but it just tells me that the context for any corrections that we see is that of a secular bull market, which to me is a good sanity check to not sell everything. I mean, not that I would sell everything anyway, but that recoveries are going to be maybe quicker than we would otherwise expect. And so far, that's proven to be a very good kind of context.
Well, let's end on that note. Those are very good arguments to be positive about equity markets going forward. Your intuition and analysis were spot on last time we spoke. I'm sure they will be this time as well. In any event, your insights and comments are extremely appreciated. Thank you very much for joining us once again, and hope to see you in person next time.
Yes, next time we do it in Spain.
Yeah, let's do so. Hasta ahí nuestra conversación con Jurrien Timmer, director global de macro de Fidelity Investments en Estados Unidos. Gracias por participar en este webcast y nos vemos en la próxima. Muchas gracias.